Okay, so what happens when a tiny 22-person IT company based out of Hong Kong sees its stock price more than triple on day one?
Yeah, after its IPO.
Exactly. Is this, the beginning of some huge new tech giant in Asia, or are we just looking at a classic speculative bubble that's, well, gonna pop?
That's the million-dollar question, isn't it? Or
Yeah.
maybe the $440 million question now.
Right. Today we're doing a deep dive into ChowChow Cloud, ticker CHOW, trying to figure out what's really underneath that incredible price action.
Our goal here is to really examine the actual business. The
Yeah.
quality, the durability, looking past that initial IPO frenzy.
And just so everyone's on the same page, all the data, prices, metrics we're using are as of market close, September 16th, 2025. That's when the shares priced at $4 just skyrocketed to $12.61.
A wild ride on day one.
Absolutely. So to really get our arms around this, we've structured today's deep dive into two main parts. First up, we'll cover Chapter 1, business analysis, then Chapter 2, management evaluation, and Chapter 3, financial analysis.
And then in part 2, we'll tackle Chapter 4, market sentiment, Chapter 5, ownership structure, Chapter 6, risk assessment, and finally we'll wrap it all up in Chapter 7, conclusion.
Sound good. Let's jump in. All right, Chapter 1, business analysis. So we're focusing on ChowChow Cloud International Holdings Limited, trades on the NYSE American, ticker CHOW. And this analysis, it's really a snapshot right after the IPO, before other market noise kicks in too much.
Right. So at its heart, ChowChow Cloud bills itself as a one-stop cloud solutions provider.
Okay.
Think of them as guides, essentially.
Mm.
They help businesses navigate the whole cloud lifecycle from planning to migrating systems and then the ongoing management piece.
Okay, and I saw they have this interesting dual revenue stream. They work with IT partner clients like integrators, telecom companies,
Mm.
and also end user clients, so things like government agencies, public utility companies, NGOs. It seems like a bit of diversification there.
It does offer some, yeah. But here's where it gets, well, really interesting, maybe even a bit concerning. This entire range of services, from high-level consulting down to AI-powered management, is delivered by just 22 employees.
Wow, 22.
22. Now, for smaller clients, maybe that jack-of-all-trades thing works, one point of contact, but it immediately makes you question scalability. How can they compete for bigger, more complex projects?
Yeah, how do they maintain expertise across so many different areas with such a small team?
Exactly. It screams key person risk. They're heavily dependent on holding on to that core talent. It's like, asking a small boutique shop to build a skyscraper. Impressive ambition, but there are real capacity limits.
That's a good way to put it. So looking at their services, they break it down into four main pillars.
That's right.
You've got the digital transformation consulting, the big picture strategy stuff,
Yep.
then professional IT services, the hands-on tech work, the migrations,
Right, the implementation.
AI-powered proactive cloud-managed services. That sounds like ongoing support, maybe some recurring revenue potential there.
Potentially, yes. That's often the goal with managed services.
And finally, IT infrastructure solutions. So setting up private clouds, integrating with the big public ones like AWS or Azure.
Exactly. Fundamentally, this is a microcap company. A
Oh.
niche player,
Mm.
really. Founded back in 2014.
Okay.
They mentioned serving over 150 clients across 2023 and 2024. Geographically, they're centered in Hong Kong and Singapore right now, but they do talk about wanting to expand across the Asia-Pacific region.
So their main pitch, their value proposition, is basically being the bridge, connecting businesses without deep cloud know-how to these complex hyperscaler platforms, simplifying the journey.
That's the idea, and the whole investment thesis hinges on this massive wave of cloud adoption and digital transformation happening in APAC. That's not just hype, it's a real fundamental shift. So they're definitely playing in a huge, growing sandbox.
But even with that tailwind, the competition looks brutal, doesn't it?
Oh, absolutely. It's coming from all sides.
You've got the cloud hyperscalers themselves, AWS, Azure, Google Cloud offering their own services.
Right, they want to own the whole stack.
Then the big global system integrators, your Accentures, your Deloittes, with massive enterprise connections.
They have deep pockets and long-standing relationships.
And then all the regional and local IT consultancies, probably competing hard on price and local knowledge.
And that leads to a key point. Given ChowChow's small size and the fact that a lot of basic IT services can be, well, commoditized,
Mm-hmm.
they're almost certainly a price taker, not a price setter. They don't have much leverage to dictate pricing.
Yeah.
And that's likely going to put a cap on their profit margins in the long run, regardless of how big the market gets.
That makes sense. And what about the Hong Kong base? That introduces specific risks, right? Even if they say no mainland China operations.
It absolutely does. You have the background geopolitical risk, potential PRC government influence down the line. It's always a factor.
And what about the U.S. side? Things like the Holding Foreign Companies Accountable Act, the HFCAA.
Yes. That's been a big deal for many U.S.-listed foreign companies. But here, ChowChow actually did something quite smart, quite proactive.
Oh, what's that?
They've used a Singapore-based auditor, Accenture Peg. And crucially, this auditor is already registered with and inspected by the US PCAAB.
Ah, okay. So that kind of sidesteps that specific HFCAA delisting risk.
It mitigates it significantly, yes. It removes one major regulatory headache that other companies have faced. Smart move pre-IPO.
Got it. So barriers to entry, low capital, needed for pure consulting, I guess.
Right. The upfront cash isn't massive.
But the real hurdles are intangible, aren't they? Building reputation, landing those big, especially government clients.
Exactly. And developing that deep, certified technical expertise. That takes time, talent, and track record. You can't just buy it instantly.
So competitive advantage, what do they really have? Brand strength is low, obviously, being new and small.
Very low. No real cost advantages or economies of scale either, given their size. Network effects don't really apply here.
So what's left?
Their most plausible advantage probably lies in switching costs.
Ah, okay. Once they're embedded in a client's system.
Exactly. Ripping them out and replacing them becomes risky, complex, expensive for the client. That creates sticky relationships, assuming they perform well.
And that brings us back to the employees. Their biggest asset is really the collective knowledge of those 22 people, isn't it?
It absolutely is.
Yeah.
Which, again, just hammers home that significant key person risk. Losing even a few senior people could be a major blow.
Okay, let's shift gears. Chapter 2, management evaluation. Who's running the show?
We have Chairman and CEO Yi Car-weng, COO Hui Ming, and CFO Wang Cheng-wei. Mr. Yi, as Chairman and CEO, is the one signing off on those critical SEC filings, taking that direct legal responsibility.
Right. But what do we actually know about their track record?
And that's the crux of it. There's a critical information gap here. We have no verifiable public track record for this team.
Because they were private before.
Exactly. Their entire operational history, how they handle downturns, how they allocate capital, it all happened behind the curtain of a private company. So public investors right now are taking a big leap of faith.
Yeah, you're betting on their ability to execute in the public spotlight without much past evidence. That definitely adds risk.
A significant layer of risk, yes.
Okay, what about capital allocation? They raised about $10.4 million from the IPO. What's the plan for that cash?
The stated plan is organic growth, mostly hiring more talent, which they clearly need, and expanding geographically.
Makes sense. M&A seems unlikely.
Highly unlikely they'd be the buyer. Given their size, they're far more likely to be an acquisition target down the road if they execute well.
Right. And shareholder returns, buybacks, dividends.
No history of buybacks. And they've explicitly said no dividends for the foreseeable future. They're retaining earnings to fuel growth.
Which is pretty standard for a newly public growth company.
Totally appropriate for their stage, yeah.
Yeah.
Although it is worth noting they did pay out a pretty chunky dividend, HKD 17.5 million, about US $2.2 million to the original shareholders right before the IPO.
Ah, pulling some cash out before going public, also fairly common.
Yep. Standard practice sometimes.
Okay, let's talk ROIC, return on invested capital. Pre-IPO, the numbers looked amazing, right? Like 59.30% TTM ROIC?
Exceptionally high, yeah. Meaning for every dollar they had invested in the business, they were generating almost 60 cents in profit. Very efficient.
But can that last, especially now with the IPO cash?
That's the key question. That pre-IPO ROIC is impressive, but it's incredibly hard to maintain as you grow, and importantly, as your invested capital base increases.
Because the IPO cash adds to the denominator in the ROIC calculation.
Exactly. They just added over $10 million to their invested capital. Their net income over the last 12 months was only $1.52 million. So mathematically, that ROIC has to come down significantly. The question isn't if it will fall, but what sustainable level it can eventually settle at as they deploy that new capital and try to grow earnings. That 59% number is rearview mirror stuff now.
All right, let's dig into the numbers themselves. Chapter 3, financial analysis. And the first number is just, wow, market cap.
Yeah, the price action was something else.
IPO priced at $4, valuing the company at $140 million initially. Then, by the end of day one, September 16th, the price hits $12.61. Market cap balloons to $442.61 million.
An increase of over $300 million.
No?
One day.
Just incredible. Now, revenue growth, we don't have a long history yet, obviously. Just the trailing 12-month revenue of $23.31 million.
Right. The F1 filing, the registration document, does give a little glimpse, shows Hong Kong revenue dipped slightly as a percentage of total from 92.6% in 2022 down to 90.9% in 2023. So maybe some early signs of diversification starting.
Okay. What about profit margins, TTM numbers?
So gross margin, 13.93%.
That seems kind of low for tech services.
It is relatively low, yeah. It reinforces that idea we discussed earlier, limited pricing power, tough competition.
Okay. What about operating and net margins?
Operating margin is 7.69%, and the net profit margin is 6.53%. So bottom line, for every $100 in sales, they keep about $6.53 after everything.
Got it. And free cash flow, the actual cash the business generates.
Again, no long-term trend yet, but for the most recent 12 months, FCF was positive, but small. $863,969. That's the real economic engine you want to watch grow over time.
Okay, financial stability, how does the balance sheet look?
Well, earnings consistency is hard to judge yet. TTM net income was $1.52 million, but the debt situation looks good. Debt-to-equity ratio is low, just 0.42.
So not much debt relative to equity.
Right. Only about $76 million in debt versus $1.79 million in equity pre-IPO money. Very conservative, very healthy. Suggests stability.
And liquidity, short-term bills.
They have positive working capital of $2.08 million. So, good liquidity suggests they can meet their short-term obligations easily. And as we said, no dividends, focused on growth.
Okay, now, valuation. This is where it gets really wild, right? The PE ratio.
Yeah, brace yourself. Based on that $12.61 closing price and the 0.04 TTM earnings per share, the PE ratio stands at an extraordinary 291.2x.
291 times earnings.
Astronomical. Extremely high. It prices in years and years of flawless execution, rapid growth, massive margin expansion, far, far above anything typical for the IT services sector.
So that immediately makes you ask, what's the intrinsic value? What's the business actually worth based on fundamentals?
Exactly. And that's where something like a discounted cash flow or DCF analysis comes in handy. Conceptually, at least.
Remind us how that works.
Sure. A DCF tries to estimate the present value of all the future free cash flows a company is expected to generate over its lifetime. You project out those cash flows, then discount them back to today using a discount rate that reflects the riskiness of those cash flows. It's like trying to value an orchard based on all the apples it will produce in the future, adjusted for time and risk.
Okay. So if you run an educational DCF model on CHOW, what does it suggest? Keeping in mind all the uncertainty.
Right, and the uncertainty is huge EE here for a newly public microcap. So any single DCF value would be misleading. It produces a very wide range.
Well, how wide?
Well, if you plug in really aggressive growth assumptions, maybe you believe they can sustain 30% plus growth for years, you might get a value somewhere in the high single digits per share.
Okay, still below the $12.61 market price.
Significantly below. And if you use more conservative, perhaps more realistic assumptions, the value could easily come back closer to the IPO price of $4 or even lower. The point is, the current market price seems quite disconnected from a plausible range of fundamental values right now.
And those DCF outputs are super sensitive to the assumptions you make, right? What are the key ones for CHOW?
Absolutely. Garbage in, garbage out. For CHOW, two assumptions are critical. First, the growth rate. Like I said, to even get close to justifying $12.61, you need sustained growth north of 30% per year for many years. If you assume a more moderate, say, 15% growth, the calculated value drops dramatically.
Okay, growth is number one. What's number two?
The discount rate. This reflects the risk. For a microcap like CHOW, with significant geopolitical risk, unproven public management, customer concentration, you need to use a high discount rate. Maybe 12% to 15% or even higher would be appropriate.
And a higher discount rate lowers the present value.
Correct. It means future cash flows are worth less today because of the higher risk. Yeah. So high growth needed, high discount rate appropriate makes it very hard for a fundamental model to justify the current price.
Okay, shifting from fundamentals to feelings. Chapter 4, market sentiment. How is the market actually perceiving CHOW right now? Any analyst coverage?
As of today, absolutely zero. No Wall Street analyst coverage yet. That's not unusual for a brand new microcap IPO, but it means the narrative is being completely driven by the price action itself.
So it's all momentum and speculation. The Moonshot narrative because it surged 215% on day one.
Pretty much. It's excitement about the price move, not deep analysis of the business, driving the conversation right now.
What about short interest? Anyone betting against it?
We don't know yet. The data from Funeral has a lag. We'll likely see the first short interest figures in late September or early October 2025. That will be a really key indicator to watch. High short interest would suggest significant skepticism building.
Makes sense. And moving averages, 50-day, 200-day.
Way too early. It's literally day one of trading. Those technical indicators need weeks and months of price data to even form, let alone become meaningful.
Okay, let's look inside the company's structure. Chapter 5, ownership structure. Who owns the shares? Any big institutions jumping in?
Again, too early for specifics on institutional owners. That data comes from 13F filings, which happen quarterly with a lag. So investors should keep an eye on SEC filings over the coming months. Seeing reputable long-term institutions take positions could be a positive signal.
What about insiders? Management, early investors.
Post-IPO specific percentages aren't filed immediately, but the critical thing here is the 180-day lockup period.
Right, prevents insiders from selling for 6 months after the IPO.
Exactly. So mark your calendars for roughly 6 months to September 16th. When that lockup expires, insiders can start selling, and sometimes that can create downward pressure on the stock price if many decide to cash out.
Definitely something to watch. And the public float. How much is actually available for trading?
This is really significant. The public float is tiny, only 7.4% of the total shares outstanding.
Only 7.4%.
Yep. That's just 2.6 million shares available for public trading out of 35.1 million total shares. Over 92% are still held by insiders and early investors subject to that lockup.
Wow, so that low float situation definitely contributes to the volatility, right?
Absolutely. With so few shares readily available, even relatively small buy or sell orders can cause big swings in the price. It amplifies the moves, both up and down.
Okay, let's consolidate the dangers. Chapter 6, risk assessment. We can use a SWOT analysis. Strengths, weaknesses, opportunities, threats. Let's start internal. Strengths.
Well, we've touched on them.
Yeah.
That niche one-stop shop approach, potentially sticky client relationships due to switching costs.
They were profitable pre-IPO with that high ROIC.
Right. And they have an established, albeit small, presence in Hong Kong and Singapore. Those are definite strengths.
Okay, internal weaknesses.
The big one is that extremely small scale. Just 22 employees limits their capacity, limits their depth of expertise across all services.
Which leads directly to that high key person risk.
Exactly. Plus, a lack of brand recognition, unproven public management team, and those relatively low gross margins we saw. Lots of internal hurdles.
Now, external factors, opportunities.
The biggest one is being positioned in that massive, growing APAC cloud market. Huge tailwind.
Potential to add more services. Like cybersecurity, maybe?
Potentially, yeah. Expand their offerings. And, of course, the opportunity to use that IPO cash to hire aggressively and maybe start expanding geographically beyond Hong Kong and Singapore.
Okay, but then the external threats.
They're significant. First, that intense competition from every angle. Hyperscalers, global integrators, local players.
Then the big one, geopolitical risk. U.S.-China, U.S.-Hong Kong tensions.
Huge, unpredictable risk. Macroeconomic headwinds are another if economies slow down. IT spending often gets cut, hitting CHOW's revenue.
And finally, the valuation itself is a threat, isn't it?
Absolutely. An extreme valuation creates the risk of a sharp, painful correction if growth falters even slightly, or sentiment shifts. The higher they fly, the harder they can fall.
That competition threat seems relentless, fighting global giants and local price cutters simultaneously.
It's a constant battle for a company like this. Finding profitable niches and defending them will be key to survival and growth.
And the macro risks, inflation, interest rates, recession fears, those can directly hit client budgets for IT projects, right?
Directly. IT spending is often cyclical and can be deferred when companies get nervous about the economy. ChowChow Cloud is definitely exposed to that.
But that geopolitical risk really stands out. The Hong Kong base, it feels like a major wild card.
It really is. You have the background risk related to the PRC, but maybe more immediate is the risk of adverse U.S. actions, sanctions, tariffs, new regulations targeting Hong Kong entities that could severely disrupt their business, their supply chain, even their access to U.S. capital markets. It's a profound and unpredictable threat hanging over them.
All right, we've covered a lot of ground. Let's bring it all together. Chapter 7, conclusion. What's the synthesis? Let's start with the bull case. If you're optimistic, what's the story?
The bull case paints CHOW as this small, agile, already profitable company perfectly placed in a massive growth industry. APAC cloud services. They have a potentially sticky client model. They use capital efficiently pre-IPO, and now they have fresh cash to accelerate growth. And that explosive day one pop Shows there's clearly high market optimism, right? Someone believes the story.
Okay, that's the sunny side. Now, the bear case, how strong is it?
I'd say the bear case is substantial, yeah. You have an unproven microcap trading at what looks like a bubble-level PE of 291x.
In a fiercely competitive market with low margins.
Exactly. With significant, unpredictable geopolitical risks tied to its Hong Kong base, and real questions about scalability with just 22 employees. Plus, that information vacuum around management's public track record and institutional ownership.
So a lot of red flags.
Quite a few. Investors are paying a huge premium for a story that still has many critical chapters unwritten and faces major potential roadblocks.
And summarizing the valuation, again, fundamental analysis, like DCF, suggests the intrinsic value is likely significantly below that $12.61's market price.
That seems highly probable, based on reasonable assumptions, yes.
Mm.
It highlights a potential major disconnect between the current price and the underlying business fundamentals as we understand them today.
So the concluding outlook. As of September 16th, 2025.
Look, ChowChow Cloud's share price of $12.61 reflects immense optimism, pricing in years of near-perfect execution. You, as an investor, are paying a very steep premium for a compelling growth story that is still very much in its early innings.
And taking on significant risks in the process.
Absolutely. Extreme valuation risk, geopolitical uncertainty, intense competition, and a very limited public operating history and track record. Buyer beware, essentially.
So here's a final thought for you to chew on. Given this extreme valuation, all these opportunities, but also all these significant risks, what does it actually take for a company like ChowChow Cloud to make the leap, to become a real Asia-Pacific tech giant, and not just fade away as a speculative bubble?
Yeah.
And maybe just as importantly, how much of their future success depends not just on their tech, but on their ability to build trust and transparency with public investors, filling that information gap we talked about. Something to think about. And that officially wraps up our deep dive into ChowChow Cloud.
Wow. It is definitely a fascinating case study, isn't it? Market dynamics, IPOs, microcaps, all wrapped up in one.
Certainly keeps things interesting.
If you found this deep dive useful or interesting, please do hit that like button and subscribe to the Stock Analytics AI YouTube channel. We really appreciate the support.
Yep. Helps us keep doing these.
And remember, our members, it's just $4.99 a month, get priority requests for deep dives on specific tickers. We're actually planning to cover all of the S&P 500 stocks over the next few months, and members get exclusive priority access to those deep dives.
Or if you just want a one-off deep dive on a stock you're interested in, drop us a super thanks on YouTube.
We do see those. And now, the important final note. Please remember, this analysis was generated by an AI system. It's purely for educational and informational purposes. It should absolutely not be considered financial advice.
Please always conduct your own thorough research, due diligence, or consult with a qualified financial advisor before making any investment decisions.
Your capital is your responsibility.
Couldn't agree more. Thanks so much for joining us for this deep dive. We'll see you next time.